So we're going to walk around a bit, so if you can't hear us or we have a problem, let us know. So yeah, I'm Mark Hunter. I'm a CPA. I'm a partner in a firm in Brantford. For almost 30 years, I've been doing tax consulting work. That's really my focus. I've worked for PricewaterhouseCoopers, a larger accounting firm here in Hamilton, and a number of years ago bought my own practice. So what I've been asked to present on is some of the tax benefits of using a professional corporation. Does anybody here run their practice with a PC? Do you like running your practice with a PC?
I'm fairly new to the game, so you tell me what I need to do.
Okay.
I think there's some benefits, not the same benefits that there used to be.
No.
But I still think there are some benefits, particularly for lawyers of my vintage that are starting to see the runway to retirement getting shorter.
Can I ask you why you set up a PC? Like what motivated you to do it?
I think really just trying to gain some, ultimately we all have to pay the taxes, but it was a way of managing and perhaps deferring some of that
Right.
payment.
Yeah. That's what I'm going to talk about today is this. To me, the professional corporation for lawyers, accountants, one of I'll say it, the only benefit that I really see is the deferral aspect. I'll give you a little anecdote. When Ontario brought in the professional corporation rules, I had a cardiologist who was a client of mine, senior guy, and his retirement was coming up. And he came to me and he said, Mark, I'm very anxious about my retirement. I don't think I've accumulated enough wealth. What should I do? And we said, well, we've got these new professional corporations. Have you looked at that? And he said, no, and we walked through it. I explained to him the deferral aspect. 5 years later, he came back to me and he said, that was the best thing that I did. I can now retire on a much larger portfolio of assets than I could have had I not set up the professional corporation. So what I'm going to do today, some people might think there are other benefits. They're very specific to your practice. I can mention them, but I'm going to really focus on the deferral aspect. You guys are all lawyers. There are some rules within the OBC. I guess it's not the OBCA anymore, the Business Corporation Act of Ontario. But also your governing body has rules that you have to be adhere to. So that's on the first slide in your slides when you get the package. That gives you a bit of background, bit of information. So I'm going to paint a picture here, a scenario, and I'm looking at a lawyer who's making net income, so revenue minus expenses is net income, of $500,000. Just gives us nice round numbers. So if you don't use a professional corporation, the scenario at the top is what you're left with. This one. And what it is it's the $500,000 of net income, and then what I've done is I've determined what the taxes are on $500,000 of income that would appear on your personal tax return, assuming you had no other income. So this is the marginal rates. So you've got low brackets, mid, and high brackets. I've used those up here, and that's the tax that you would pay each year, leaving you with $272,000 in your bank account from which you live. Okay? So that's if you don't use a professional corporation. The scenario at the bottom, can you guys see that? Are you okay? Can you see it from that table? Am I blocking you? You're good? So this scenario is if you use a professional corporation, and there's two scenarios within that. If you're a sole practitioner, you would be looking at this scenario. If you're a partner and your professional corporation is a partner in a partnership, you're likely falling into this scenario. And I'll give you a little bit more detail in a minute. But if you're a sole practitioner and you set up a professional corporation and you earn $500,000 in that PC, the tax that the company pays is $61,000. 12.2% is the flat rate on $500,000 of profit. meaning the professional corporation is left with $439,000. We have fees too. $439,000. This scenario, the reason why there's two different scenarios here is there's what's referred to as the small business deduction. So in Canada, if you earn business income, the first $500,000 earned inside a company is taxed at 12.2%. Every dollar above that is taxed at 26.5%. This scenario assumes there's none of that small business deduction. And that happens when you're a partner in a partnership, where your PC is a partner. So, for example, if your PC was one of 10 partners and you were allocated 1/10 of the profit, your small business limit would not be $500,000, it would be $50,000. You have all the partners share it pro rata. So for this one, all I've done was said there's no small business limit applicable to this scenario. The tax rate is 26.5%, so it's going to pay $132,000 of tax, leaving it with $367,000. So you compare that with what you would be left with as an individual, and you can see this deferral. The problem with this scenario is, well, Mark, what am I going to live on? You're leaving all the money and all the income behind in the company. Absolutely right. So that's the summary there. So if I go back, the difference between the numbers is summarized on this slide. So what if you come to me and say, well, Mark, I can't leave that. I need that income. So the company is set up. The company earns $500,000 of net income. The company pays tax. Whatever's left in the company is distributed to you as the shareholder, leaving nothing left in the company, and it does that annually. What you get is I'm going to flip ahead to another slide. What you get is no benefit at all. That is the difference between what you had paid as a sole proprietor versus what you pay corporately and personally if you take all the money out each year. And you can see there's really no benefit. In fact, under this scenario, it's a detriment to you. So if you're thinking that you're going to do this professional corporation and you're going to leave all your cash in there, or you're going to benefit from this deferral, but you need to draw all the cash out annually, it's not going to be a benefit for you. So back to the deferral aspect. Let's look here. So I've run the two scenarios, and what I've done here is what I've tried to paint for you in this slide is, well, what if you left the money behind, but you only drew out a certain amount of it each year? And the amount that we're drawing out is $200,000. So under this scenario, where there's this $500,000 small business deduction, the company's left with $439,000 of cash once it's paid its tax, and now it writes a check to the shareholder of $200,000 per year, right, and draws that money down. So I've taken that $200,000 and I put it into a tax return using the marginal rates to figure out how much tax that person or that shareholder would pay each year on $200,000. The two scenarios generate two different tax amounts. This is annually. So under this scenario, $200,000 coming out triggers $50,000 of personal tax. So you do that until this $500,000 or $439,000 is drawn out completely, and pay your tax. The total tax you'll pay is about $414,000. So you see what you're left with after you've paid the company tax, your personal tax. You're left with $324,000. You would have been left with $272,000 as a proprietor. You're over $50,000 ahead. Right? That's the power of the deferral. If you can leave money behind in the company, which ties into what Sasha is going to talk about, if you can leave money behind, that's where you'll benefit. And the more you leave behind and the longer you leave it there, the more you'll benefit. So it becomes, the analogy is, this becomes your retirement plan. You do away with your RSPs, you leave your money in your company, you take out what you need annually, as little as possible, leaving as much as you can behind. It becomes quite powerful. And that's at drawing 200 out. If you can lower that, you're going to obviously get a much better deferral.
Can you invest that money
Yes.
through the corporation to make it a little more?
Yeah, so back to, I don't know if I put it in the opening slide. Yes. So under the Business Corporations Act, it's very specific, and it wants you to put in Article 5 of your Articles of Incorporation this. The Articles of Incorporation must say the following, that it's only going to be carrying on the practice of law, except including the investment of surplus funds earned by the corporation. So yes, you can. So we've seen portfolio stuff, we've seen insurance policies, we've seen real estate, right? We've seen lots of ways to invest that after-tax corporate money. And that's where it gets powerful. So what Sasha's going to look at here is, she's going to say, yeah, incorporate, because I'm going to have an extra $50,000 a year that I could invest with you. More than that, possibly. Up to $167,000 a year that I could invest inside your company and grow that. That's a lot more capital working for you, not working for our government. So I think and you'll see, even if you are a partner, you'll see that you're still further ahead using a professional corporation if you're a partner with limited access to that small business limit. Okay? I think it's a powerful tool. I use a professional corporation. My partner uses a professional corporation. I think they're good, powerful tools.
How does it factor in when you include RSP deductions?
You don't. Once you set up a PC, the way I've set this up is you're drawing the money out as a dividend.
Right.
Which does not create.
Holding back like $200 million. Like if I put it, I don't remember what the cap is because I never reached it. What, like is it 25%?
18%.
18%.
Yeah. Or
Okay. Like that isn't taxed at all, whereas this is at least taxed at 12.6.
Yes, but there's correct. So you're going to get a deduction off your personal. So let's say you put $20,000 in. You get a deduction off your personal tax return of $20,000 at whatever your top rate is. So it could be quite a good deduction. The $20,000 goes into your RSP. It's locked away, right? Out of sight, out of mind kind of thing. Sasha invests that $20,000. It grows. The return on that is not taxed, but when you draw the money out, it's taxed as pension income. All of the tax efficient rates that apply to investment income are no longer accessible to you on the growth inside your RSP. I don't like them. I think they're one of the biggest government scams out there. Because you put money in, and it converts all the tax rates to the top personal tax rates, rather than like a capital gain. Well, now the capital gain rate's 36%, but dividend rates are 36 to 47, whereas the personal tax rate, the top rate is 53. So you've converted all of that lower taxed income into pension income, which is conceivably taxed at upwards of 53%. So I don't like them. I would much rather you did this, pay the 12.2%, leave the money in the company, invest it there, grow it there. If there's a capital gain in the company, there's still tax advantageous ways to get money out through what's referred to as a capital dividend account. If there's dividend income earned, you can make distributions out and still have lower personal tax rates on those on the payment out of the company. So I'd much rather you did this. And that's what I would advise all my clients to do. The other aspect is, in order to generate the RSP room, you've got to take a wage out, which means you have to pay CPP on it. So that's upwards of, what, $6,000, more than $6,000 a year now, right? Because you'd be paying it twice, for yourself as the employee and once again as the employer, like you do on your personal return. So you don't have that anymore. So you'd say that's an immediate savings. You don't get your CPP when you retire, but how much does that really work out to? So, any other questions?
Maybe it relates to the question, but the annual dividend is $200,000. I usually pay myself a salary. But can you do that dividend like on a monthly basis, or you draw it up to $200,000, or does it have to be annualized?
No, you can take it whenever you want. You could take weekly, different amounts each week when you need it.
You don't have to remit on that because it's
Right. You just have to budget and make sure you have enough come April 30th when your tax return goes in, right? And that can be an administrative headache because you're used to doing the source deductions, which means when you do your T4, the tax is already there. And then all of a sudden you get your tax return done on a dividend and you owe $50,000 and you're like, oh shit, what happened?
So I was told by my accountant that I have to prepay now that they know
Yeah.
that I've averaged a certain amount. Now I have to prepay, so I've done that. But if I want to switch to this annual dividend thing, what
It wouldn't make it. So once you're into an installment regime, that means that your tax that you owed last year was more than $3,000. So that's likely, if you've got a PC, that's likely going to be the case when you take dividends out. You're always going to owe money if you and you've made installments to offset that, but you'll still next year they'll say, well, you still should do installments. Right? So you'll always have the installments, and it won't make any difference as to when you draw out the money in the year. It's just the total you've drawn out in the year. Correct. Yeah, it's investment income. Completely different tax regime, completely different spot on your personal tax return. So because it's not employment income, you're also not generating RRSP contribution room going to a dividend. Right?
But if you need to qualify for mortgage because you're moving to a larger house, the bank does want to see employment income for teachers.
Got it. Thank you.
Okay, thanks, Mark. So I'll introduce myself first, and then maybe I'll get some questions going so I can address what's kind of maybe a hot topics right now. So my name is Sasha. I'm a financial planner for RBC. I spent last 13 years in banking. Last 8 years was Royal Bank. Majority of the clients that I work with are either business owners, professionals, or medical doctors. Because generally there's more complexity when it comes to dealing with someone who has either a business or professional corporation on how they pay themselves, how they draw an income, right? Does it make sense to use one's registered plans versus other ones, right? This is kind of what the guidance that I provide for clients. Well, first of all, let's address the elephant in the room. I know that Trump was elected. It's not going to be an economic presentation today. And however, we're going to be okay. That's our bottom line from our chief economist, okay? So the first thing I had here, this is just something that I use always for discussion with either it's a business owner or a law professional in kind of a first meeting, right? How they own the business or practice, do they know what it's worth, right? What if something unexpected were to happen, right? And for the ones that are approaching retirement, what that retirement is actually going to look like, or do we need to start thinking about it? Okay, so do you want to maybe get some questions kind of going, because it's a pretty broad slides that I have, and I kind of can jump what maybe it's top of the mind for you guys. Question? I know you had a question. Yeah, go ahead.
I have a question, Jeff. Most of small practitioners, sole practitioners, small firms, have an operating line of credit for their firm.
Okay.
Right, that they use to pay their staff and make sure there's enough money to meet their overhead on an ongoing basis. And in your personal life, people also have debt, right?
Yes.
Yeah. Mortgages and whatnot. If the interest on your debt is higher than what you would make on the investments, should you invest?
Okay.
Or should you just pay debt? Because, and to put this in context of a lawyer's career trajectory here. Okay, so I was 45 when I finished
the average age of retirement for a lawyer in Ontario is 74. And I wouldn't be surprised if now it's closer to 80.
Oh,
I see a lot of older practitioners.
Yeah.
And so I'm just wondering, if you have debt, is the end game you work for the rest of your life, you manage to pay your debt, and then that's it? Or or should you invest if you have debt, or should you pay your debt?
Okay. Yeah, it's definitely a good question. And I think this slide is really relevant to it too, right? Because one of the things that is the foundation of any financial planning is realizing what your cash flow looks like. What's coming in and what's coming out, what payments you have, financial obligations on your personal side, right? So if we're talking about a sole proprietorship, so you are the practice, right? There is no professional corporation. Things are a little bit different when there is a professional corporation. But we always need to kind of start, what are our lifestyle expenses? What do we actually need to live off, right? Whether it's food, mortgage, right, paying off the debt. It's okay, let me pay out the debt and I'm going to start, putting money away when I'm 50 or 55, right? It kind of needs to be always a balance, because the one thing that you always will miss out by start saving later in life is that power of compounding of that money, right, over time. So for someone who start investing in their 20s versus their 40s, even if they double up on the amount that they put away, they're still missing out on hundreds of thousands of dollars just because the time in the market hasn't been as long, right? So there's not a right answer to ask the question. Again, it comes from a cash flow perspective, because building your net worth is lowering your debt load and increasing your assets, right? So when we talk about like student debt, for example, professional lines of credit for many lawyers and doctors that I work with, right? And right now the interest rates recently obviously been also higher. Does it make sense for them to start saving aggressively when they have a $350,000 line of credit? That's an average line of credit that I see with like medical doctors, right? Once they graduate from school. Right? So absolutely it makes sense to pay down some debt, but at the same time, even if it's like couple $100 a month worth of savings, it still adds up over time. So it kind of comes to your goals. Do you want to stay in your house forever, right, if you're paying down your mortgage? Is a downsizing something that you will consider 20 years down the road, right? There's not one financial plan that's going to be exactly the same. Okay? So it kind of comes. I want to say the two things that always come to mind is that investment and tax planning, and the bottom line, optimizing net worth and cash flow. Just looking, okay, what do you bring in? Can we improve tax efficiency? And where does it make sense for you to apply this extra cash flow? Because yes, you're right. Like if your debt is, and I've seen some mortgages, especially with variables, right? Like recently at 7% and 50-year amortization, and they hit a trigger point in the last 2-3 years. For that client, it makes sense to stop all the savings contributions and put the money towards the mortgage, right? But things change because the interest rates get lower, right? But then investment returns get higher, right? So it's kind of like you need to adjust your plan based on the market conditions, based on the cash flow and your personal circumstances. Yeah. Go ahead.
Can you go back to the dividend versus employment income and like getting a mortgage? Because I haven't had employment income in years. I've been doing nothing but dividends.
Couldn't hear you, sorry.
So the question is, yeah, go ahead. One more time, sorry.
If you could go back to the employment income versus taking dividends,
Maybe I should
and
go.
like if you need financing and I guess getting a mortgage.
Okay, yes. Getting a mortgage. So and I don't personally do lending, however, obviously I work with, whether it's RBC Private Banking, whether it's our financial advisory team or mortgage specialists that do lending for clients. So the way that the bank looks at lending, they want to see a consistency of T4 income, okay? And the reason for that is dividend out of corporations generally it can vary, right? Sometimes you can take $100,000, sometimes you can take $200,000. Bank likes to see consistency in the income. That's why we're looking at the T4 income. there is like more a little bit flexibility for someone who is in their peak earning years, like our private banking division would look at everything because we realize that law professionals retain the money within a corporation and there is enough cash flow, right? But however, for newer lawyer who's starting up, right, they want to see that T4 income. So T4 income is paying yourself a salary out of the professional corporation, right? But again, maybe it's, if you need to qualify, I don't know, just throwing numbers there, maybe, I don't know, $500,000 mortgage, it's probably like $1 million now, right, to buy a house, but you need anywhere between $100,000 to $150,000 in income, reported income in the last 2 consecutive years. So it's something that you also want to be planning for. If it's a house purchase, right, you want to be discussing with your financial advisor and the banker who you deal with. What do I need to do right now from an income perspective to get me there by, I don't know, 2026, right? Okay, any other questions? Yeah, go ahead.
If you're in a corporation
Uh-huh.
and you have this choice then, dividend versus salary, if you have children, you have to take the salary because if you're offsetting child care, it has to go against income, can't go against dividend, correct?
Right, that's correct.
And is there any other reason that there'd be some sort of benefit to taking salary? Other than those 2 things, mortgage if you're looking to purchase, or if you have children, you need to offset against salary with the taxation. Is there anything else like either of those that we should consider?
Maybe you've got some employment expenses you want to deduct, right? Maybe there's some travel costs that you want to deduct as an employee of your professional corporation.
But it's your corporation, so the corporation's already deducted.
The company can be doing that.
But if they want to collect CPP,
Yeah, if you want to collect
Yes.
CPP.
You want to collect CPP, or in some circumstances when I work with the families, let's say maybe we have a practicing lawyer and maybe the spouse is stay home, right? And we want to equalize the assets. So like, for example, the spousal RSP plan might something that makes sense, where you want to pay yourself a little bit of salary, so you get your self-deduction limit for retirement savings plan, but then you switch those assets to the spouse. So when you are the contributor to this retirement savings plan, you get a tax deduction, but your spouse actually owns the asset. Because there's only 3-year rule applies to those spousal RSPs, even if it's 5 or 10 years from now, your spouse turns around and takes the money out of that spousal RSP, it's going to get taxed in their hands. So it's a little bit of like asset shifting, right? But, yeah, go ahead. Oh, okay. Yes, well, that's it. Like, I was like, I can keep going because you can talk about those things forever, yeah. But if anyone has a question, yeah. So what I have here, in fact, is just like a quick overview on the registered plans, right, in Canada. I want to say the number one that, you want to be taking advantage of is a tax-free savings account. Yes, you have to have personal money in order to put to the tax-free savings account. It's an after-tax money that you put in, but it grows tax-free basically forever, right? So any surplus on a personal, on the personal cash flow side that doesn't go towards the debt repayment, that's something that I think everyone should be building off. Because that is one of the things, whether it's passing to it's passing to the kids, whether it's in case of emergency, you create a tax-free pool of money that will never be taxable. That whether 10 years from now you have to pay for your kid's wedding or there's something else comes up, you can use this TFSA money, right? Within the tax-free retirement savings plan and a professional corporation, the same type of investment options are available, whether it's a pooled funds, whether it's individual stocks, whether it's guaranteed investment certificate, it makes no difference. So investment options are the same, is the taxation of that investment income is different. So those plans are whether RSP is tax deferred upon the withdrawal, tax-free account, the growth is forever tax-free, and any non-registered account, so non-registered, not TFSA, not RSP, and neither of the educational plans, they are, the investment income is taxed in the year whether received or a gain is realized, Okay, so I think someone asked whether you can invest the money within a professional corporation. You absolutely can. So majority of law professionals or medical doctors I work with, they do invest within the professional corporation because, number one, you have more dollars to invest. And a second, it doesn't just limit. If you put the money to RSP, this is it. Like, this is just for retirement. But what if you decided 15 years from now that you wanted to buy a building for your law practice or expand the practice, or there is something else, right? There is more flexibility when you invest the money within a corporation. You basically create like a retirement savings plan for yourself. Yeah, go ahead.
So my earlier question
Yep.
was this, but that's a good segue.
Uh-huh.
If you have the corporation, you're sole practitioner, you choose to retire, you're not working anymore.
Uh-huh.
Corporation's still there. You have all that money in there.
Yep.
Can you just continue to pay yourself for the next 5, 10 plus years?
Yeah.
Even though the business is just not really practicing?
That's what I meant when I said it becomes your pension plan.
Yeah.
Because you'll retire, you'll deregister it as a PC, and now it's just a pool of funds, and you can take a dividend out of there each year.
And you still just pay your taxes on the corporation and
Well, the tax in the company's not going to earn any professional
Investment.
income. It'll all be investment income. It'll continue to pay tax.
on that?
Yeah.
Yes.
So you run that and, okay.
Yeah, there's no active business income, but there's passive income on the growth of the investment, yeah.
That's
But,
how I have it set up, but listening to you, I wasn't sure if I did the right thing. Thank you.
yeah. And honestly, it does depend on personal circumstances, right? Because a lot of times when there are kids, when there are a lot of personal expenses and we don't have a lot to leave in professional corporation, it might or might not make sense, right? Yeah. Any other questions? I didn't put a lot of slides because I wanted to make sure that I also address a couple other things. So there's a sole proprietorship, as anyone has practices that has other lawyers that work in or own their practice. Okay, yeah, okay, sounds good. Yeah, so the one thing that I also kind of wanted, as a part, there is obviously personal financial planning and how you build your net worth and what it makes sense for you and your family. For any law professionals that I work with that also own their own practices, they also have a responsibility of taking care of their employees, right, and other lawyers within the practice. So something that I wanted to mention is, like, as the Royal Bank offers what's called a Group Advantage retirement savings plan and pension plans that we can set up, whether it's for a business, whether it's for a law practice, where you can, that helps you basically retain the main talent and attract the talent that you need for your firms, and it helps them to set up those long-term registered plans, whether it's a retirement savings plans, whether it's a pension, whether it's a tax-free savings account, with or without your participation, right? So sometimes for like $1 that you put in, that the employer or your practice can match 50 cents or $1, right? Like that's something else that kind of helps, instead of writing a check every year, right? You don't even know what your employees are going to do with it, right? Maybe they're going to just spend it on the mall, right? Which majority of people do, right? You actually help them to, if I give you something extra, it actually goes towards, their financial future, right? And obviously practice owners can do it for themselves as well. Okay, yeah, and I have Janice here with me, so if anyone has questions with regards to kind of that's her area of expertise, right? Yeah, like can ask her after. But any last questions for me?
I do.
Yes, like question.
I'm thinking from like retirement planning perspective, with the RSP, you can name a beneficiary, so it doesn't go through the estate.
Correct.
The money's been held in your PC, I'm assuming it would
Yeah.
be a state asset.
Yeah.
Probate on.
No.
If you have a corporate will.
Oh,
Yeah, there's a secondary will that's definitely something. If professional corporation is the part of your overall net worth growth and investment strategy, yes, it should be a secondary will that's set up for those shares of PC. Yeah, the same as for businesses. So it's not the secondary will, like a corporate will. that will be, so like let's just say if there is $1 million in your professional corporation, right, and if there is a secondary will, even the shares belong to you. If there is a secondary will, that it's not going to go through any probate process, so it's not going to go through 1.5, what is it, around 1.5%, right, of the estate assets that are on single name are subject to the probate. If there is a secondary will, it's not excluded, yeah. Yeah, no probate. There could be an income tax, depending on, what your distribution looks like, but yeah. So retirement savings plan, if you name your spouse or common law partner, then it's just a tax-free rollover to their name, if you name beneficiary. If you name anyone other than your spouse, a child, mother, father, right, then the value of the asset flows to that beneficiary's name, but it is deemed disposition to your estate. So if it was worth $200,000, right, it's going to be on your last income tax return. Go ahead.
Hi, sorry, I'm a family law lawyer, so as
Okay.
soon as you said that, the question went through my mind was
Yeah.
spouse. What is your definition of spouse? Does a separated spouse, would apply, or does it have to be a
No, I think it needs to be.
separated spouse is
Yes.
excluded?
Yeah.
This is the tax definition.
I feel like it's a tax. Yeah.
Right, that you get a deferred rollover.
So the deferred rollover could not take place to a separated
No.
spouse?
No. You
And
cannot.
there's a specific provision in the Tax Act that deals with what is a spouse.
Yeah. Thanks, Mark. Yes, I do know that too. Like, yes, like usually it's a common. Yeah, go ahead.
Thank you. You said we can invest in the corporation. I understand that part. What about if your investment also has real estate? You have multiple real estate investments.
Oh, okay.
What happens with that on that taxation?
Yeah, is it
Probate question
per-
over there?
okay?
What happens with real estate?
Is it personally owned?
No, it's owned by the corporation.
Same
I have
thing
my
as
own.
the shares own the company. Shares own all that real estate, it passes on.
It's only the shares.
It's the shares, right? You don't. It's not personally owned. That's it. Yeah.
So it's still the same, you just put it in the will?
Secondary will.
You'd still only deal with the equity stake you have in the
Yeah.
company. Because you're a shareholder in the company.
Yeah.
The company owns the real estate. And the company
exactly.
owns the investments. So that has nothing to do with what you own. You own the shares in your company. And whatever the company owns makes no difference as to what the treatment is of your shares. So you'd only be dealing with your equity interest in your company, not the real estate. So when your secondary will says that my primary, it attaches the two wills. The primary will deals with all the assets that would need to go through probate. The secondary will deals with specifically your shares in your PC, which then don't have to go through probate. That was a court ruling, I don't know, 20 years ago, Ontario court ruling that did that. You guys are a bunch of lawyers, you should know.
I did.
You're taking me back to tax class. I hated that.
She's a family lawyer.
Oh, I
No, I'm a criminal defense lawyer.
Okay. Family lawyers over here. Yes, family lawyer had a spouse question. Yes. Good.
I got a question for you. How do I get out of jury?
Jury. Oh wow. Yes, go ahead. Yeah.
One was, if you have a practice where you have a business loss, right, and so you're not paying income tax, can you voluntarily contribute to CPP? I think you have that before.
Yeah, you just increase your loss.
Yes.
So if you have a loss, you can contribute to CPP.
You just increase your loss in the company.
Yeah.
Because the CPP would become income. Right? So it's just like a very small wage.
Right, okay. The other, no, I didn't mean receiving CPP.
No, I know. It would go to the Canada Pension
You
Plan.
can voluntarily contribute to the plan.
Yeah, but it's an expense to the company.
Right, okay.
So it just becomes an increase in your loss.
Yeah.
An individual who doesn't have a company do that?
If they're in a loss,
Yeah.
oh, I don't know. That's a good question. Voluntarily contribute?
Yeah.
More than likely, I would think. But I don't have an answer for you.
The other question I had was,
It's a,
And I would probably have a family trust own the shares.
yeah.
And
It's
the
an
reason
asset.
for that is because your PC has flow-through liability, right? So if you have that building in there, it's up for grabs on litigation.
Yeah.
If you own it personally, it's up for grabs on litigation. But if you put it into its own company, and the company maybe is owned by a family trust, then you might be protecting it from your own liability. That's actually how I've got my building set up.
And of what if you wanted to sell the building too, prior?
Yeah.
Yeah. Go ahead. I think you had a question in the back. Yeah.
I was just wondering if it's quick to touch on, you talked about insurance policies, asset investment strategy.
Yeah, it's pretty nice. So I'm personally not insurance licensed, okay, because banks on the Bank Act, if we are BC Bank employees, right? But just basically like, I obviously have partners within Royal Bank that can discuss the insurance products and why or why not it makes sense. But it's just also another vehicle. If, I want to say this, right, like clients who don't need all the assets they accumulate within the professional corporation. And we are looking at passing those assets to a next generation, to your kids, right? Because you own the shares, right? And the risk could be opportunity where if you put the money to an insurance policy, you can get some of this money out of professional corporation tax-free. So, right? So it's going to pay like some of the liability from a tax standpoint. So it's not really a planning. It's not for you. It's for next generation, right? That's kind of what. So it's insurance policy and all the growth, right? When we talked about taxation of the investment income, right? Mark said that any growth within a professional corporation of the investment income needs to be reported. That's not the case with insurance policies, right? That are corporately owned. Yeah. So that's a very broad. Yeah.
We've gone over time.
Yes, but we're still here if you want. So guys, yes.
Which is